Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. I'm your host, JP DaCosta, and welcome to another show. Today's topic is something that's been happening recently in the market, and a lot of people have been asking me about it. So I decided to do an episode on it, and it's titled Government Bonds and the Impact on the Property Market. So those who have been watching what's going on in the news have noticed that there's been a sharp rise in government bond yields in the US and in Australia. And on the back of it, we've seen a decline in stocks around the world. Now, we at Valmika, we treat property as a financial instrument as well. So just like you've got commodities, you've got interest rates, derivatives, you've got stocks, you also have another class in property. And we treat them all as financial instruments, and they're all interlinked and they influence each other. Property has a lagging effect, whereas commodities, stocks, interest rates have a preemptive impact in the financial markets, but they're all linked and related, and they're all influence each other. So the recent uptick in government bonds. So government bonds are issued by governments around the world. And in America, they're called US Treasuries, for example. And governments around the world issue these bonds to raise money in the form of debt. And they use that in their fiscus and to grow the economy and invest it back into the economy. So they're a very important instrument that is used worldwide. And in Australia, we have the same thing, and all countries around the world have the same thing. Now, you would have noticed and you would have heard in the press that there's been a huge uptick in US Treasuries, in particular the long ends. There's been what we called a disinversion of the curve. So the curve has become more flat, whereas prior to the last month, it was very inverted. Curve shapes are very important in financial markets. So when you've got an inverted curve, it means that you're coming close-ish to the top of a hiking cycle. And the curve inverts, meaning the yields in the long end drop because the market's pricing in interest rate cuts. And that's on the back of the high interest rates in the short end having an impact on inflation, bringing inflation down, therefore markets implying interest rate cuts coming down the line. But what's happened is when you usually come to the end of a hiking cycle and you go into a cutting cycle, you get what's called a bull steepening. Bull steepening means that the yields in the shorter end decline quicker than the longer end, and that causes the curve first to disinvert and then to steepen. But what's happened here is you've had a bear curve flattening or disinversion, which is unusual, especially when you're coming towards potentially the end of an interest rate hiking cycle. And what this is implying, it's implying very strong economic data and the Fed maintaining high interest rates for longer. But I'll talk about why those yields have increased. And it's a few factors. The one that I've already mentioned is strong economic data, especially in the wage sector, and sticky inflation, with the rhetoric coming out of the Fed stating that they're going to stay higher for longer in yields. Therefore, that's put pressure on yields in the longer end of the curve. So 10 years, 20 years, 30 years, US Treasury yields to increase. So that's one reason. The second reason is the US government has issued quite a significant increase in more bonds. So that's increased supply. Now, the way bonds trade, I'm not going to get too technical here, but the way it trades is it trades on price. So if you increase the supply of anything, the price of that will drop. But price in bonds are inversely proportional to yield. So when you get a drop in price, the yield increases. And that's why you've seen an increase in the yield, because there's more bonds available, more supply, and therefore a drop in price and an increase in yield due to the increase in supply. So that is a second very significant factor contributing to yields going higher. The third reason is the Fed is going through the quantitative tightening cycle now. So that's opposite to the quantitative easing, meaning that they are not only letting bonds roll off their book, maturing and not replacing them, which increases supply, but they're also selling off bonds. And by selling off bonds, you're increasing the amount of supply in the market as well. So selling of bonds, more supply, increase in yield. So it's like a perfect storm, so to speak. You've got strong economic data, you've got an increase in government issuance of bonds, and you've got quantitative tightening. Those three, perfect storm. And that's what caused the longer end of the curve to disinvert. And that is a very significant factor for property in the US as well. And it's got a little bit of a different dynamic to the way it works in Australia. So in the US, when mortgages, when people buy property and they get mortgages to finance the property, it's all fixed interest rate mortgages and fixed over 20, 30 years. And the way they determine the fixed interest rate is a spread above the US Treasury yields. So if your base yield, which is your US Treasury, is increasing, then naturally your mortgage rate is going to increase in the US. So it has a significant impact in the US market. And it has an immediate impact in the US market because they are issuing more mortgages off that base rate. And high interest rates mean a slowdown in the economy because less people will be purchasing property. The less people purchasing property means there's an increase in supply in the property, and that will naturally lead to property prices in the US declining on the back of it if it remains this high. So that's its direct impact in the US. Now, how does that impact Australian market and Australians' property market? Now, Australia's got a different dynamic. It works in Australia, we don't have mortgages that are fixed as long as the US market is. So when you go to the bank and you get a mortgage, if you want to fix it, the most you can go is 3, maybe maximum 5 years. But generally, it tends to be what we call floating interest rates. So an impact to the longer end of the Australian government curve doesn't have the immediate impact on the Australian market purely because of the mechanics of our mortgages are different to the US. However, it has an impact on the economy. So naturally, because the US interest rates or yield curve, the Treasury yield curve has increased, it has caused the Australian government curve also to increase in the back of it. And why is this the case? And it's got to do with demand supply metrics. So if you've got higher interest rates in the US, the theory goes that investors would naturally be attracted to those bonds and purchase those bonds because they've got higher yields. And to purchase government US treasuries, they need to purchase US dollars to buy them. And to do that, they'll make the US dollar stronger, which naturally implies the Australian dollar will get weaker in the back of this. And with the Australian dollar getting weaker against the US dollar, it will imply inflation in Australia. And that's because we purchase oil, for example, in US dollars. So with a weaker Australian dollar and purchasing oil and fuel in US dollars, naturally it's becomes more expensive and more inflationary because the impact of higher fuel costs will filter straight through to all the other underlying products, for example, food, um, consumer staples, etc. High inflation will naturally imply a slower economy. So it's a difficult balancing act with the RBA. Even though the mandate is not to target the Australian dollar, the currency, the impact of having a weaker dollar will imply inflation, which is the mandate for the RBA to target, and that will imply naturally higher interest rates in Australia. And those higher interest rates are reflected straight away in the Australian government bonds. So that's the direct impact in Australia. Now, the effects of higher interest rates are a common factor on how they'll impact property. Higher rates are negative for property. So with the impact of higher yields in the US will naturally form a weaker Australian dollar, will naturally form higher yields in Australian government bonds. That would mean it'll become more expensive for people to finance their mortgages because interest rates naturally would go higher on the back of it. Secondly, corporates, when they issue their bonds, so corporate bonds, it's also reflected as a spread over Australian government bonds. And it's all got to do with credits spreads, which is a topic for another day. But because your base rate is increasing, it means the issuance of corporate bonds will naturally be higher as well. The cost of funding is higher, which means that corporate profits will be negatively impacted by that. So there is a natural slowdown in the economy. And that's how it reflects through to stocks as well, because they price the negative impacts of higher rates into stocks. However, there is a silver lining. On the back of these higher yields around the world, it is naturally implying a slowdown in the world economy. And because it's implying a slowdown in the world economy, it means that there is less demand for oil on the back of it, so oil prices. So you would have seen that there's been a significantly and rapid decline from the high of oil, which was around $95 a barrel, to around $82 a barrel, which is a very rapid decline. And this is in the face of the OPEC countries still sticking to the guns of not increasing output. So even though that news has come out, oil has still dropped, oil prices have still dropped, and it's because of this implied slowdown in the world economy due to higher government bond yields. I hope you found this session valuable, and I will now move on to the auction clearance rates for the weekend of the 8th of October. South Australia still remains the highest clearance rate in the country, with clearing at 79% and Adelaide at 80%. New South Wales clearing at 68%, with Sydney clearing at 69.7%. Still a relatively strong showing. Queensland clearing at 60% for the state. However, Brisbane has a strong 72.2% clearance rate. Victoria also clearing, having a good clearance rate this weekend at 71.15%, and Melbourne clearing at 72.72%. And then lastly, looking at Western Australia, which is not a large reflection of sales in the state, but nonetheless, Western Australia is clearing at 45.45% and Perth clearing at 33.3%. I hope you enjoyed this episode, and I look forward to speaking with you in the next one. Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you are interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.